Okay, guys, let's take a look at problem 3.5a. Okay, at the end of the current year, the unadjusted trial balance is shown below. Okay, so see this? So all these numbers here are the end balances that are the result of all the journal entries we made and subsequently posted to the ledger. Okay, but we need to make some end of the year adjustments, and then we're going to prepare the adjusted trial balance. So let's take a look here. It says the data needed to determine the year-end adjustments are as follows. Unexpired insurance at July 31st, $4,800. Let's see what our prepaid insurance balance we currently have. It says we have $7,200, and this is telling us that in actuality we only have $4,800 left. So the difference between those two amounts is $2,400. We need to record an expense for the amount that we used, and this credit here to the asset will reduce it to the correct amount, which is $4,800. Okay, it says supplies on hand at July 31st, $600. Let's take a look down here. Supplies, $1,980. That's currently what we're showing. But when we took a look, we only have $600 left, right? Well, the difference between those two, if we had started out with, or if we had 1,980 throughout the accounting period and we're left with only 600, that means that the difference of 1,380 right here is the amount that we used. Okay, so we record an increase to our expense with a debit and a decrease to supplies with a credit. Okay, so that's a reduction to the asset with a credit. Depreciation of building for the year, $3,100. Okay, so with the depreciation expense, we record that as an increase with a debit, and instead of actually crediting the asset of depreciation, the asset of the building itself, right? We use this accumulated depreciation account, and this is called a contra account. Okay, so that's very very important to know that. Remember, with the historic cost principle, we need to see what we paid for each asset, and as a result of that, it's very important that the accounting records, in order to follow that, we have to, instead of reducing the asset itself when we depreciate it, we use this, like I said, contra account. So this typically has a credit balance, and we increase it with the credit, and the effect of this is that it reduces the total assets. So we're having an increase in an expense, which reduces our equity, and here we're having a decrease in our asset via the increase in a contra asset account. Okay, let's take a look at the next one. Depreciation of equipment for the year, $2,700. Okay, so this same thing. We have a depreciation expense, and we have accumulated depreciation. And notice we're specifying if it's the building or the equipment. We need to be able to know which one we're accumulating the depreciation for, what class. We wouldn't have a specific an account for every specific asset, but for each major class, like buildings and equipment and things like that. Rent unearned at July 31st is $1,750. Okay, let's take a look down here. It says unearned rent, $6,750. Well, now we're saying the actual amount is $1,750. Okay, so we earned some of this this rent. So we have people that rent property from us, right? And so right now we have a liability on the books of I'm sorry, where is it? Here we go. Unearned rent right here, $6,750. Well, we earned $5,000 of that through this accounting period. Okay, the difference between what we were showing on the books in the unadjusted balance and between what we actually know has been earned, right, or what the balance should be, is the amount that was actually earned of $5,000. Okay, so we increase our revenue, which increases our equity through a credit of $5,000, and this debit here to unearned rent, this is a liability account, so when we debit the liability account, it's reducing it. So we're reducing a liability and increasing our equity. Okay, we accrued salaries and wages at July 31st of $3,000. So these represent wages that we owe to people that have been working for us, but we haven't recorded it yet. They've worked for us, and we need to, at the end of this accounting period, we need to record the expense. Okay, and we need to record the offsetting liability since we have yet to pay them. It says here, fees earned but unbilled on July 31st, $10,750. Okay, well, we know that if we've earned them, we need to record the revenue in the period that we earned it, and we haven't billed them yet. It hasn't been entered into our accounting records. So basically all we're doing here is going to put this into the accounting records, and this is how we do it, just like we would any other time we've earned revenue but have yet to receive payment. Okay, so we increased our accounts receivable and we increased our the equity via an increase in revenue. Notice here we have a description of each. It's very important when we're making these adjusting entries to give an explanation of what took place. Okay guys, so the next thing we're asked to do is to prepare a adjusted trial balance. I just wanted to zoom in here on Old Galloway Company here and take a look at the unadjusted balances, right? So what happened was we have the unadjusted balances, then we would have made adjustments. Those journal entries that we made would have been entered into the journal. They would have then been posted to the ledger, and after posting them, we would have different balances in some of these accounts. If we made a journal entry that impacted one of these accounts, right, I know we didn't do anything to affect dividends, however we did do something to affect fees earned, didn't we? Well, after we're done posting all those and we looked at the new balances, we would have a new set of figures for our adjusted trial balance. Remember, at all times, all of our debits and credits must equal. Give me a second here to get this guy straightened out. Okay, so this is what our adjusted trial balance would look like. Okay, so not all of these were impacted by the adjustments that we made, but a good bit of them were, correct? So cash wasn't adjusted. Accounts receivable, I remember we made an adjustment that affected that, right? So it went from $38,400 up to $49,150. Prepaid insurance, we reduced that from $7,200. After we made the entry and after we would have posted it to the ledger, we would have had a new balance of $4,800. Supplies, they were originally at the unadjusted trial balance $1,980. Okay, and we can see that now they have been reduced to $600. So after we make all of these different adjustments here, now look, we have these accumulated depreciation accounts in here, right? And let's see here, our balance went from $137,550. It increased to $140,650. I'm sorry. Okay, so any of these that we made a journal entry using in the account was part of the journal entry, the balances are going to change. When we get to the bottom here, we see now that our total debits are $819,550, and our total credits are now $819,550. Okay, originally our debit and credit balances each equaled $800,000. So we still stayed in balance. However, we just have a different number now for them. At this point, we could take a look at all of our revenue here is this fees earned, and we have our rent revenue as well. We'll take those two, add them together, and if we were to subtract out all these expenses, after making all of these adjustments, these are all up to date, and we should have the proper amounts to prepare. This would give us the proper amounts to prepare the income statement, and then we could prepare the statement of retained earnings and use these figures up top here to prepare a balance sheet. Remember, it's very important that at the date the financial statements are prepared that we've made all these adjusting entries so that our balance sheet balances are correct and we have the proper amounts that will be shown up on our profit and loss statement.